the last part to this chapter is reversing entries. So one of the things to keep in mind with reversing entries is that they're 100% optional. You don't have to do them. Basically, what a reversing entry is an attempt to reverse a month-end adjusting entry. So it's exactly the flip of what you did to set up an accrual. So if we accrued, and the example we'll use here is wages payable. If we accrued wages payable at the end of the last month by debiting wage expense, crediting wages payable, the reversal is just the exact opposite. To reverse that, we debit the payable and credit the expense. Basically what you're trying to do is just offset exactly what you did at the end of the last month. Okay, so you're going to flip the debit and credit, you're going to post it on the first day of the next month, and that's going to reverse your entry. Now, once you get a little bit more sophisticated, you actually can change the reversal date. So you can change the reversal date for in current accounting software. You could do it in the first day of the next month. You could do it in 2 months, 3 months, 6 months. You can actually ask it to do or to reverse whenever you want it to. You can put in the reversal date if you choose. Most commonly, though, it's going to reverse on the first day of the next month. So, and like I said, accounting systems have the ability to automatically reverse accruals. A lot of times what you can do is when you're entering the journal entry in, there'll be a little checkbox that you can say, is this entry to be reversed, or is this a reversing entry? You check the box and it automatically posts the reversal on the first day of the next month, unless you specify something different. So let's take a look at an example and see if we can apply this reversing entry methodology. We're going to go through 2 steps. The first time we go through this, we're going to take a look at a payroll cycle, and we're going to ignore the reversing entry. So again, I said these are optional, right? So we're going to take a look at this Blondia Rocks example. We're going to go through and we're going to ignore the reversing entry. We're going to process everything without it, and then we'll go back through and we'll process the same situation using a reversing entry. What I want to achieve is I want to prove to you that no matter which method we choose, whether we choose to do a reversing entry or not, it has the same net impact on your statements. All right, so we have Blondia Rocks. They pay $21,000 in payroll weekly, each Friday. Staff are all salaried and work 7 days a week, right? Meaning that they generate $3,000 in payroll expense per day. Payroll was last paid on Friday, July 28th. We need to record the following things. So they get paid every Friday. They get paid for 7 days a week, and they get paid in total $21,000. So they make $3,000 a day. The last time we paid payroll was on the last Friday, which is July 28th. So we're now at the end of July. We're at July 31st. I want to take a look at the month-end adjusting entry to record our accrual, right? Because 3 days have passed, the 29th, the 30th, and the 31st. We need to accrue 3 days worth of payroll at the end of the month, right? So we'll do an adjustment for that. And then I also want to take a look at the payment of the next payroll on Friday, August 4th. So what happens then, right? So at month end, 3 days have elapsed, like I mentioned. We said that staff generate $3,000 in wage expense per day, right? $21,000 divided by 7 days, and I can bring up that calculator again. 21,000 divided by 7 days. They generate a $3,000 expense per day, right? Oops. So if 3 days have elapsed, then we have a total of $9,000 that we need to accrue at month end. So the adjusting entry of July 31st, and this shouldn't be anything new, you should be used to this. We're going to debit wage expense for $9,000 and credit wages payable for $9,000. That's our month-end accrual, right? We talked about this at the beginning in the first video, right? Why we do adjusting entries and accrual-based accounting. This makes our statements accurate and up to date. Even though we haven't paid that wage expense, we still need to accrue it. All right. So again, this first time through, we're going to ignore reversing entries, which means that there's no entry to be done on August 1st. There's no reversal. But on August 4th, we have to record the actual payment of payroll. So now we have to record the payment of payroll. One hint here is don't forget to reverse out the payable, this one, that we set up at month end. Okay. You'll notice as I work through this course, I tend to do things in the same order all the time to try and give myself some consistency. In accounting, sometimes you don't necessarily understand the theory behind every single thing, but if you can make it somewhat mechanical, you can muddle your way through the things that you don't necessarily know perfectly. So one of the things I always do when I do a journal entry is I deal with the cash first, because that's so simple, right? I know if I spend money, I'm going to credit it. If I get money, I'm going to debit it, right? And this payroll cycle, we know that we pay $21,000 a week for payroll. So on August 4th, we have to pay that payroll out, which means I'm going to start by crediting cash for $21,000. So I'm going to credit cash for $21K. Now what I have to do is record my debits. Well, back here at the end of last month, I set up a payable of $9,000. Well, if I pay my staff $21K, then I don't owe them this payable anymore, so I need to clear it out. So I'm going to credit cash for $21K, I'm going to debit wages payable for $9,000, and I'm going to essentially plug the difference to wages payable. Or sorry, I apologize, wage expense. Now, I say plug, but you can actually calculate that if you want, right? If you look at what date this payroll is being paid, it's being paid on August 4th. So August 1st, 2nd, 3rd, 4th. There's 4 days in the month that have elapsed. So 21,000 divided by the 7-day work week times 4 days will give you $12,000. That's what we need to expense for the month of August. Okay? So without a reversing entry, those are the two entries you would do. You would start by accruing a $9,000 wage expense at the end of the month, and then you would record the $21,000 cash payment, clear out the payable, and set up the expense for the current month. That's your standard process. Let's take a look at how all this changes though if we decide to use a reversing entry. So same situation. In that case there was no reversing entry, right? So again, just a reminder, when we ignore reversing entries, we have to remember to manually reverse out the accrual that we posted. Well, with a reversing entry, we don't have to worry about manually reversing or pulling out that payable that we set up. It happens automatically within the system. So same example, we pay $21,000 a week in payroll, and we pay every Friday. Staff are salaried, they work 7 days a week, and we last paid payroll on July 28th. What we're going to do now is we're going to take a look at the month-end entry, we're going to take a look at that reversal, and then see how that impacts our monthly payroll payment. Okay, so the journal entry is the same as before to accrue at month-end. We still have to accrue for 3 days of unpaid wages. So the adjusting entry is still going to be debit wage expense, credit wages payable for $9,000. There's no difference. All right, that stays exactly the same. Right, 21,000 divided by 7 days in a work week times 3 days to accrue means we set up $9K at the end of the month. The difference here though is that we're going to reverse this entry on the first day of the next month. Remember, we said reversing entries are just the exact opposite of what you posted as the accrual, right, or as the adjustment. So to reverse this out, all we need to do on the 1st of August is now debit wages payable for $9,000 and credit wage expense for $9,000. Okay, we do the exact opposite entry of what we did at month end. So now you can see there we debited wage expense for $9,000, and here we credited wage expense for $9,000. In this one here we credited wages payable for $9,000, and in this one here we debited wages payable for $9,000. So essentially, effectively, we've cleared that transaction off our books. It has a nil impact now. There's no impact on our statements. The beauty of a reversing entry is that it simplifies your payroll entry. And payroll is just one example of when you might want to reverse an accrual or an adjusting entry. But in the payroll situation that we have here, the beauty of this is that it simplifies our payment of payroll. Because we've already reversed out the accrual from last month, all we need to do at the payment date is to credit cash for $21K and to debit wage expense for $21K. So you might be a little bit confused right now and thinking, well, why is all that going to a wage expense? We didn't have $21,000 in wage expense in the month of August. We only had four out of the 7 days. If you run your math, right, 21,000 divided by 7 days times 4 days in the month of August, well, we should only have 12,000 in there. Why are we putting 21? Well, look at what happened back here on the reversal. What did we do? We debited wage payable and credited wage expense. So we have a credit to wage expense of $9,000 and a debit to wage expense of $21,000. Draw your T account out. 21,000 minus 9. There's your $12,000 in payroll expense. Okay. So at the end of the day, it all works out. The beauty of this, though, is that this entry is simplified. So you might be asking too, well, why do we even care? Why do I want to simplify that entry? Well, the reality of the situation is that the person, if I go back, the person doing this accrual at the end of the month may not be the same person that does this wage entry, right? Typically, the person doing accruals is a more senior accounting person, either a senior accountant, a staff accountant, or an assistant controller. Those types of roles might be doing your adjusting entries at the end of the month, an accounting manager, right? You could have someone who has limited accounting experience, but is your payroll, your HR person may be doing your payroll and may actually be inputting this entry. So by us reversing the entry, we can tell that person that you don't need to go figure out what we posted as an accrual at the end of last month and reverse it. The only thing you need to know is that every time you pay payroll, you credit cash, you debit wage expense. That's it. So it simplifies this role, right? Because typically the person doing, or sometimes the person doing this entry isn't quite as experienced as, say, you would be when you graduate, or someone with more of an accounting background, right? So, and again, like I said, there's no net difference on how this impacts our statements. Let's take a look and compare the two side by side. We've got wage expense. On the left side, there's the situation where we had no reversal. On the right side is where we reversed the entry. So in July, if you remember, in both situations, we did a $9,000 accrual. So in our wage expense account, we had $9,000. Perfect mirror images. That's exactly what happened, right? If you go back to the entry that we did under a no reversal, where we didn't use the reversing entry, when we booked our wage expense, we credited cash for $21,000. We reversed the accrual, so we debited wages payable for $9,000, and we debited wage expense for the other $12,000 to balance that entry out, or to record the last 4 days, or the first 4 days of August. Everyone remember? Okay? So that's our situation. We had $9,000 in wage expense in July and $12,000 in August when we didn't reverse it. Now, let's see if we can prove with the reversing entry that we end up at the same spot. Again, in July, we had a $9,000 accrual, so that went to wage expense. That's perfect. But if you remember, on the first day of the next month, we reversed that out by debiting wage payable and crediting wage expense. So now we're sitting with negative $9,000 in the expense account. That seems a bit off. But then think of the payroll entry when payroll was actually paid. We simplified it. All we did was credit cash, debit wage expense for the full $21,000. So we set up that $9,000 reversing entry. We record payroll with a simplified debit to expense, credit to cash entry, and look, the net impact is $12,000. So they had the same effect on expenses. It's just a different way of doing it. And that's why it's optional. That's why you don't have to do it. It doesn't always work or make things easier, so you really have to pick and choose when you might want to do this. But again, reversing entries, they're optional. Some managers like to use them, some don't. Right? Some managers feel that when they use reversing entries, or if they fail to use reversing entries, accruals will end up on the balance sheet and just stay there forever because we forget about them or they get lost in the shuffle. Okay? So by reversing entries, we can make sure that we don't have any of that, those accruals that kind of might get lost in the shuffle.